We have analyzed many popular funds in the past. Some were top performers in their categories and some were rising stars that got investors' attention in recent years. But today, we will discuss a fund that is not as popular as Parag Parekh or Quant FlexiCap fund, but it has proven itself to be a reliable investment option over the long term. It has done well in most years, but has its shares of underperformance too. However, it has always bounced back. If you were an investor in this scheme, you definitely wouldn't have much to complain about. We are talking about 361 Focused Equity Fund. It has been a top performer in its category, and in October 2024, it also joined the group of funds that have been in existence for over a decade. Despite its solid long-term performance, it has not gotten much attention. Now, this fund also selects stocks using an interesting but simple framework. So if you also invest in stocks directly, this will be an exciting video. Hello and welcome to ET Money's YouTube channel. Today we will examine the investment style and performance of 361 Focused Equity Fund. Now there are a lot of data points and insights that will help you analyze funds and choose the one that's right for you. But before we begin, a quick update. This video is part of our fund review playlist where we have analyzed over 14 funds. Some of these reviews have crossed over 2 lakh views. I'm sure you too will find value in those videos. Now let's start by looking at the investment style of this fund. Let me start by briefly talking about focused funds. They are just like FlexiCap funds with one restriction. They can invest in a maximum of 30 stocks. So, the fund managers can invest across large, mid or small caps. However, the total number of stocks in the portfolio should be below 30. Now, when it comes to mutual funds, a 30 stock portfolio can be considered concentrated. Typically, mutual funds have 40 to 60 stocks in their portfolios. Now, due to this investment constraint, fund managers are cautious before investing in any company. The margin of error here is very thin. Now, with that background, let's discuss 361 Focused Equity Fund stock picking framework. Now, the scheme follows what is called as SCDV framework. This framework primarily looks at two factors: one, growth in profit after tax, and two, returns on equity. Now, based on these two metrics, the framework classifies companies into four segments. First is secular businesses. So, if a company has a profit after tax or PAT growth of more than 15% and ROE of more than 15%, it is classified as secular. Some sectors where you usually find such companies include auto and auto ancillaries, NBFC and retail. The second segment is cyclical companies. These are businesses growing their PAT by more than 15%, but the return on equity is less than 15%. Sectors where you usually find such businesses include capital goods, cement, infra, oil and gas, and so on. Now, if a company has a ROE of more than 15%, but the PAT growth has declined, it is classified as defensive. Examples include healthcare and IT services. The fourth segment is value traps, where both PAT growth and ROE are less than 15%. Telecom companies are an example of such businesses. Now, the fund house classifies companies into these four segments and allocates them weights. Companies falling in the secular segment are used to form the core portfolio of the fund. Cyclical and defensive segments are used for tactical allocation. The fund invests in value traps if there is a turnaround opportunity. As companies with higher PAT growth and high ROE form the core, the fund's investment style is growth oriented. So this is primarily how stock shortlisting works. After shortlisting companies based on PAT growth and ROE, the fund management team evaluates them based on other parameters. Now, to better understand the fund's investment style, we looked at allocation to different market caps. This will tell us whether the fund follows an aggressive or a conservative investment style. A large cap heavy fund can be considered conservative, while a portfolio with high allocation to mid and small caps would be aggressive. We looked at the data for the past 8 years. Here, we saw the fund's allocation was tilted towards large cap companies in most periods. Now, as of September 2024, the fund's large cap allocation was 61.09% and it has remained over 50% in the past 8 years. Now, the allocation to mid and small cap companies ranges from 25 to 40%. So, these were the two observations from this data. First, the fund is a large cap heavy fund. Second, historically, its market cap allocation has not seen a drastic change. Now, we also looked at the category average numbers to see how other funds deploy their assets. we saw that most of the funds in the category are heavy on large caps. The reason why focus funds prefer large caps could be because of their investment constraint. They have to keep limited stocks in their portfolios, and mid and small cap companies are more volatile than large caps. The next parameter we looked at is the fund's portfolio turnover ratio. The portfolio turnover ratio is a good metric to see if the fund manager follows a buy and hold strategy or is churning the portfolio frequently. A ratio of more than 100 implies that the entire portfolio was churned during the past year. Now, as of September 2024, the portfolio turnover ratio of this fund stood at 38. For the past 3 years, the ratio has remained under 50. This means that the portfolio's churn is not high and the fund manager prefers to hold this investment for the long term. Okay, we also looked at the fund's portfolio in detail to analyze the buying and selling pattern further. First, we looked at the top 10 holdings. Here, we observed that except IndusStar, all the 9 stocks in the top 10 holdings have remained in the fund's portfolio for a long time. This shows that the fund manager has a high conviction in his bets. We also looked at the fund's portfolio beyond the top 10 stocks, and there were some interesting observations. First, we found that a few stocks were held for a short period. For example, the fund manager invested in Suzlon only for 3 months. During this period, the stock generated a return of approximately 59%. Similarly, the fund manager invested briefly in CAMS, Hindustan Levers, and Welspun Corporation. Now, another thing to observe here is the allocation to these stocks. It's usually low between 1 and 3%. Now, this could mean that the fund manager did active buying and selling with some portion of its assets. This trend was more apparent when we looked at the fund's portfolio before Jan 2022. So, it is possible that the fund manager used a portion of its assets for momentum investing before January 2022. However, the frequency of buying and selling has reduced since then. Now, let's summarize the investment style of this fund. First, it's a large cap heavy fund. Second, the investment style of this fund is focused on growth companies. Third, the fund manager invests a large portion of its assets using a buy and hold strategy and a small portion using a momentum strategy. Alright, let's now look at the performance of this fund during different periods. But before we proceed, if you're still watching this video, I'm sure you have found this insightful. We do a lot of research and curate content that you can use to fine-tune your investment strategy. So I recommend you subscribe to our channel and press the bell icon so you never miss a video from us. Now, to analyze the returns of this fund, we first looked at the short and long-term trailing returns. Now, if we look at the returns for 5 years and longer time horizon, the fund has done well. It has outperformed both the category average and its benchmark. Its ranking in the category was also impressive. However, the fund's performance has slipped if we look at returns for the past 1 and 3 years. Its ranking based on 1-year trailing returns was 21. The returns were also lower than both the benchmark and the category average. Next, we looked at the periodic returns to further understand its performance. Since 2015, the fund has performed better than the benchmark and the category in 5 out of 10 calendar years. Its performance was particularly impressive between 2019 and 2021. Now, during these years, the fund not only outperformed its peers, but the margin of outperformance is also quite high. In the previous section, we discussed that before January 2022, the fund manager was actively doing momentum investing with a portion of its fund's assets. Now, this could be the reason for impressive returns during those periods. However, in recent years, the fund's performance is not very impressive. Now, one factor dragging the fund's performance could be its 8.6% allocation to HDFC Bank. The bank has not generated good returns in the past few years. Now, this could be affecting the fund's recent returns lately. Now, we also examined the fund's rolling returns to analyze its performance consistency. We analyzed 5 and 7-year rolling returns since inception. In both time durations, the fund's average rolling returns were better than those of peers and benchmark. Its 5-year average rolling returns were 18.31%, while the category average was 15%. The average rolling returns were also north of 18% during the 7-year period. The category average was 14.5%. Now, this shows that the investors who have been with the fund for the long term have generated better returns than the benchmark and peers. We also examined the minimum and maximum rolling returns of the fund. Here, the fund's performance was also better. The fund generated better maximum and minimum returns than its benchmark and peers during both time frames. Now, let's see how the fund has done in terms of downside protection. To analyze this, we looked at the quarterly returns of Nifty 500 and shortlisted the quarters in which it generated negative returns. Next, we map the returns of 361 focus equity fund and the focus funds category average. Here, we anticipated focus funds to be more volatile than their benchmark due to their concentrated portfolios. However, the data showed otherwise. Since 2015, we found 12 quarters where Nifty 500 generated negative returns. The average performance of focus fund category was better than the benchmark is 7 out of 12 quarters. This was surprising as we anticipated focus funds to be more volatile. Next, we looked at the performance of 361 focus equity fund. Here, we found it to be better than Nifty 500 in 6 out of 12 quarters. Okay, let's summarize the findings now. The fund's long-term returns are impressive. It has outperformed its benchmark and been a topper in the category. It had exceptional performance in 2019, 2020 and 2021. During those years, the fund manager took tactical or momentum calls with some portion of its portfolio. After January 2022, the frequency of churn has reduced. Now it would be interesting to see if this fund would continue this exceptional performance in the coming years. Overall, if you are looking to add focus funds to your portfolio, this fund can be a good candidate to consider. The fund has a sound investment process and has done well in the long term. And with this, we have come to the end of this video. I hope you found this video useful. And if you did, please don't forget to share it with your friends and family. I'll be back soon with another video. Till then, take care.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.